Why is Wall Street spooked and the market selling off? How many interest rate rises lie ahead after the Reserve Bank raised yesterday? And finally, is China helping the iron ore price? I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. Well, Paul, everything was positive. A great November for stocks, and now they're selling off. What do you think's behind it?
Well, I guess there are two reasons. Obviously, there's still contradictory data out there, Peter, because the ISM was really strong, the employment data was really strong. So, you know, the idea that the Fed is suddenly going to stop increasing interest rates, I think, is sort of gone to one side. So we don't really know. We know maybe 0.5% in next week, and then who knows what they'll do in 2023. But the market hasn't ruled out the fact that they're not going a lot higher. Yeah. Then I think secondly, you know, it is all the technical indicators still say it's still a bear market, you know, and bear markets you sell rallies. And we've had a good rally in the US, better rally here in Australia, I should say, but US market, I guess, a bit of profit taking ahead just to see what happens with next week. So,
and of course, we all know you can't trust 1 month's data. And that's the interesting thing. And I think all this anxiety will keep on going until we see that inflation number on December 13 in the US. And if it's lower than expected, markets will go up. If it's not lower than expected, the markets will go down again as it's sort of like a prelude to.
You know, monthly data is so volatile, the measurement processes are so unscientific that you need to see a few months of this to actually confirm that their action they're taking is starting to work. And I don't think we're there yet. So.
And so what you're also saying is that the last inflation read in America, which was good, which helped the rally, it may prove to have been a rogue good number and a bad number might come. So it's anxiety until December 13. Luckily, 13 is not a Friday, Paul. Luckily.
It is indeed, yeah.
Okay, let's go to the next one. The Reserve Bank raised interest rates yesterday, 0.25%. The market thought 70% expected it, 30% said maybe a pause is due. Now, what is the market and economists' basically the consensus view on how many rate rises are there?
I think consensus view, and there seems to be a bit of a unanimity amongst this, but not everyone, about 2 more increases next year. So that would be 0.5%, take the rate to 3.6%. Yeah. But, you know, there are others. You know, Shane Oliver's out this morning, very respected participant or regular someone who comes to our programs a lot, Pete. As you know, Shane thinks maybe we might have seen close to the top.
Good on you, Shane.
And the CBA, I believe, is only looking for another 0.25%. There are still some on the other side, but settling on 0.5%. I guess the same scenario, Peter, that is that the idea that maybe inflation is close to peaking and so we're on the slope down. I don't yet think we've seen the data to substantiate that. So you've got to be a little bit careful on this stuff.
We've got one okay quarter, a good monthly number, but we have to get the next quarterly number to confirm we're heading in the right direction. And that doesn't come out, Paul, until late January.
Late January. I mean, I guess you could also, there are a lot of good indicators, you know, in terms of some of the forward-looking indicators, things like, you know, transportation rates and shipping rates, oil prices down again, you know, petrol prices are coming down, and they also all feed into inflation ultimately, not just because it's a one-off, but it builds in every cost. Yeah. So there are a lot of positives you could find, but we still have a really tight labour market. Yeah. And, you know, just hard to know whether, you know, go back to 2 to 3% seems like a long way to go.
Yeah. The one thing I think is interesting is that Dr. Phil Lowe did actually sort of say, I'm still going to be driven by data. So watching the data is going to be really important. And also, he kind of alluded to the fact that he's a little bit worried about what happens in June, July, when a lot of people go off fixed home loans on the variable. That's when I think spending will actually fall in that second half. And you might be thinking, I better not overload this monetary policy tightening because it works with a lag. So you might get the lag effect coming through in June, July, just when that fixed loan effect comes through as well. And it might really push us close to a recession if he's not too careful. There's a final one, Paul. China, you're the one who brought this up. China and COVID policies and iron ore prices.
Well, no official change in the COVID policies, but certainly just in terms of what the Chinese authorities have done, relaxation of rules around, you know, around people in lockdowns and whether they need to travel on the train, they need to, you know, show their test results. Clearly, they're easing off, right? Yep. They've heard the message from the protests, and that's all got to be a real positive for Australia, Peter, because the thing that's been holding us back in the last few months has been Questions marks about the growth of the Chinese economy, but clearly it almost seems like we're getting a reversal. We're not going to, we're not getting any formal change in policy, but there's a big movement you can see. They want to get the economy.
And the market's anticipating. That's why the iron ore price is sneaking up, and the BHP and Fortescue was really been clobbered, and now it's rebounded, hasn't it?
Yeah, so look, I mean, I think in those commodities, I've always said, look, they haven't really seen the change. They're still raking the cash in, right?
Yeah.
And there's no sign that's not going to continue.
And it's great for the budget deficit here because the coal price is really helping, but the iron ore price has been a great help for a number of years. If it remains high, Treasurer Chambers may well be in a very good position if the economy slows down in the second half of next year. And he might be in the position to give those tax cuts in 2025.
He might. And I think what's really interesting, you look at the Australian market, we're about break even year to date. Add it, we're almost break even. Add in dividends, the Australian market is up, which is really quite an outstanding result. So if you're crying and thinking superannuation's all been lost, it hasn't, right?
Yeah.
There's lots of asset classes, fixed income and other things that have gone down, but good old equities, the Aussie equities, we're almost back in the black for 2023.
And Paul, I can't
2022, I'm ahead of myself, Pete.
Paul, I can't help remembering one of our critical viewers who actually said, when I said, well, maybe if this inflation comes down and the market rebounds, we might actually gain 10% this year. And he called it comedy gold.
Yep.
Comedy gold.
Well, you take it. We've got our fans and we've got our detractors, and positive Pete here. You take a bit of a rap occasionally from those out there, but look at the numbers, folks. Yeah. Right? It's actually a little bit positive for 2022.
And I guess the bottom line is, if December 13 does prove to be a good number in the US, we might well see that our market gets up 6%. We'll have 4% for dividend. I'll call it 10%, Paul. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.